So ServiceNow is posting 19% subscription growth, a 21% jump in booked business, and just cranked its AI revenue target up by 50% to $1.5 billion. But when you look a little closer, the math starts to fall apart.
To even justify its $106 billion valuation, ServiceNow has to nearly triple its revenue to $30 billion. I mean, at its current price to sales multiple, that's what it takes just for the stock to double.
And hitting that number, it means they have to sustain over 15% growth every single year for 5 years straight. With enterprise budgets getting squeezed and all these geopolitical issues popping up, well, that is a really tall order.
Right now, the market seems to be mispricing three critical things. First, it's not really weighing the risk that AI could actually disrupt ServiceNow's main business, even as the company calls itself the AI Control Tower. Second, it's probably underestimating the massive market expansion from their new Armis security acquisition. And third, it isn't balancing the crazy growth in new areas, like CRM, against a pretty major slowdown in their federal government contracts.
So this really puts ServiceNow at a fork in the road. Is it about to be hollowed out by this new wave of agentic AI, or is it about to become the single most critical orchestration layer for this entire new era?
To figure that out, we're going to break down the business. Then we'll run through the bull and the bear cases. And we'll finish up with the 3 key signals that are going to tell you exactly which way this is heading.
So first, what exactly is ServiceNow? It's a cloud platform that automates all these digital workflows for huge companies, and it's positioning itself as the central AI control tower for business reinvention.
And their dominance inside these massive enterprises is pretty clear. In the first quarter, 17 of their top 20 deals actually included 7 or more of their products. That shows you just how deep and sticky the platform really is. But they're not just upselling. They're also landing enormous new customers. The company just closed its largest ever new logo deal, and it was valued at over $15 million.
Okay, the bull case. It really starts with AI. Revenue is accelerating so quickly that management just raised its 2026 target by 50%. That's from $1 billion to a new goal of $1.5 billion.
And their main AI product, Now Assist, already blew past $600 million in annual contract value. The number of deals that included 3 or more of their AI products, that grew nearly 70% year over year in Q1.
Then you've got strategic expansion. The $7.75 billion acquisition of the security firm Armis literally triples their addressable market in that sector. And at the same time, a new partnership with Google Cloud is injecting Gemini AI straight into the very lucrative 5G telecom market.
And the underlying demand still looks incredibly strong. Their contracted revenue pipeline for the next 12 months, they call it CRPO, grew 21% to a massive $12.64 billion.
Because of that, management felt confident enough to raise their full-year subscription revenue guidance by $205 million. They're now targeting almost $15.8 billion for 2026.
CEO Bill McDermott frames the whole bull case like this. ServiceNow is the AI control tower in the center of a growing $600 billion plus total addressable market.
Okay, but the bear case starts with valuation math that really doesn't add up. At a $106 billion market cap, ServiceNow trades at a forward PE of 23.9x. That's almost identical to Microsoft's 24.1x. So the market is implying that ServiceNow is going to grow with the same kind of stability as a $3 trillion titan. That leaves absolutely no room for error.
And these geopolitical headwinds, they're not a blip. They are structural. The conflict in the Middle East created a direct 75 basis point drag on their Q1 subscription revenue, all from delayed enterprise deals.
And the AI threat isn't a question, it's a fact. You've got agentic AI directly bypassing core ServiceNow modules. Anthropic's Claude is already being used to automate complex insurance claims processing, and Salesforce's Agent Force is competing directly with them to handle CRM customer support tickets.
You've also got some really serious margin pressures. The $7.75 billion Armis deal is going to create a 75 basis point headwind to their operating margins in 2026. And this is all happening as government spending is falling off a cliff. I mean, U.S. federal obligations plummeted 72% year over year.
And finally, the insiders. While they only sold about $1.7 million in shares recently, which is a tiny 0.0016% of the company's market cap, the more telling fact is their total ownership. Insiders own just 0.34% of the company. That is not a lot of skin in the game. So to sort through this disconnect, here are the 3 signals that are really going to tell the story. First, AI revenue. The signal to watch is whether Now Assist's annual contract value crosses $1 billion before the end of this year. If it does, the bull case for AI monetization is pretty much confirmed. If it stalls out, that is your first major warning sign. Second, geopolitical recovery. The tell here is if management explicitly removes the Middle East conflict as a headwind in their Q2 or Q3 guidance. If they stop talking about it, it means the global deal pipeline is recovering. If that excuse sticks around, the slowdown is deeper than it looks. And the final signal, new customer growth. New logo ACV growth was over 50% in Q1. If that growth stays above 30%, they are successfully holding off the competition. But if it decelerates sharply below that, it's a clear sign that those AI-native rivals are starting to win deals head-to-head.
This all leads to one final question. Will agentic AI ultimately reduce the number of human software seats that ServiceNow can sell, creating a permanent, structural headwind to its entire business model?
Next time, we're going to be breaking down the platform war between ServiceNow, Salesforce, and Workday. Until then, track the signals.